Good morning and welcome to this Monday, January 27th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we had a rough day on Friday. Market hadn't seen anything quite like that in a while, and futures are really bearish this morning. Media is using a lot of the coronavirus news and information as headlines. I usually don't pay a whole lot of attention to the media. I try to follow the charts. This is not something that's too surprising to me. We've talked about this over the last couple of weeks, how it just looked like we were maybe heading for a short-term top. Pointed out a number of different reasons why, and I think that's the bigger problem here, more so than the news headlines that we're going to try to point to. Let's go ahead and take a look first. Actually, before we get into that, I do want to mention to everyone we are having a Q4 earnings webinar later today. That is at 4:30 p.m. Eastern Standard Time. So if you're a member, obviously you are invited. We'd love to have you. If you're not a member, great time to join because you can join for no cost. So let me just show you. If you go over to EarningsBeats.com, first of all, there's an area where you can subscribe to our free Earnings Beats Digest newsletter. Talk a lot about earnings and relative strength and how you can use that to improve your trading or investing. Again, that's a free newsletter that comes out Monday, Wednesday, Friday mornings. We had one out this morning. And so that's just a way, I think, to hopefully hone in some of your skills. And if you're not really familiar with relative strength, I would highly recommend it. I think it'll give you a lot more perspective on the market. And then up here, you can see the Q4 earnings webinar. If you're not a member, you can just simply go in here, click on this no-cost 30-day trial. So essentially what you will do is you sign up, you'll get charged $7, but then we'll refund you the $7. So if you'd like to come in for the Q4 earnings webinar later today, that would be awesome. What I plan to do is just talk about earnings that have already come out, some of the better ones that I've seen in earnings season so far, maybe companies you want to keep in mind, maybe on a watch list, and then also take a look at some of the upcoming earnings reports and maybe give you a little predictive value out of the webinar and talk a little bit about some of the reports that I think will be really strong based on the way these companies have been trading, not just on their absolute charts, but relative to their peers. Money comes into the market, it rotates into various areas, and Wall Street decides, okay, if I'm going to put my money into semiconductor stocks, which ones am I going to put it into? And you can take a look at how semiconductor stocks are performing relative to others and get a really good sense as to what Wall Street already knows about the market. And so sometimes I think it gives us really good clues heading into earnings reports. But if you're interested, go to EarningsBeats.com, make sure you get signed up. Okay, as far as today goes, well, I'll get into the futures and all that in just a moment. It's not very pretty. But we do have Friday's action to go over, and you can see, first off, that the end of last week just wasn't very good. Actually, all of last week really wasn't very good. And that's the week that the market tends to not do well. We've talked about this over and over and over again. I always bring it up. The 19th to the 25th of all calendar months, when you combine them, I would say December maybe is an exception month. And maybe even November isn't as bad around the Thanksgiving holiday. But those first 10 months, January through October, the 19th through the 25th really tends to struggle. And we saw it again last week. You can see the Dow moved lower last week. The S&P was trying to go higher, couldn't, ended up finishing down for the week. Same goes for the NASDAQ. Mid-cap and small-cap both got hit harder, as has been the case really for the last year and a half. And then when you look at the industry group strength and weakness from last week, you'll see utilities, another good day, real estate doing well. Healthcare was not so good. Consumer discretionary financials, not so good. So those were the three weaker areas. Real estate actually went down, but it was just still the second best performing sector. And what we've seen a lot of lately is utilities, real estate, consumer staples, mostly utilities and real estate. leading the action. And you can see this move in January. It's been huge. And I think that's a problem. One of the things that we look at when you start setting records on the major averages like this, and you're being led by defensive groups, it's telling you the market's rotating, Wall Street's getting a little bit more defensive. So that's just one of the clues that we could talk about. And I'm going to get into some of those others in just a minute. But not a great day on Friday. 10-year Treasury yield, you can see, took a big tumble. I'm going to give you an update here because it is down again big today. Here you can see the big move down on Friday. We were down, I don't know, 5-6 basis points. And now today we're down another 6 basis points, although this was mostly on the open. Still, 6 basis points down to 1.62%. Taking out these prior lows, which I did not like. I do want to point out that when you've got a yield that's dropping like this, when you're in a secular bear market, this kind of action would normally lead to a lot of selling in equities for the past month and a half. Normally when money is rotating into treasuries, that sends the yield lower. And when money is rotating into treasuries in a bear market, that normally is money coming out of the stock market. In a secular bull market like we've been in, the big moves to the downside in the 10-year Treasury yield have mostly just been met with sideways action in equities. Now, I think there's a lot going on right now, and I think the big steep drop here in the 10-year Treasury yield is going to add fuel to the fire for an equity market that badly needs to pull back and consolidate the gains that it's seen especially over the last 3 to 4 months. So 10-year Treasury yield, you can see down 1.62. I think what this is telling me, we've got a Fed meeting coming up tomorrow and Wednesday. I don't think this is telling us that growth necessarily is weak. I think what this is telling us is that inflation, that we are in a disinflation, not a deflation, but a disinflation period where inflation is coming in below expectations, below target levels. So we still have inflation, but it's just not great. And you can look at a lot of different charts. I'll skip ahead here, but here's the CRB. And you can see the CRB just over the last few years, last couple of years, year and a half, pretty big drop in the CRB index. And if we go out 10 years, you'll see that the CRB since 2011 has just been dropping and dropping and dropping. So if you're looking for inflation in terms of higher commodity prices, that just hasn't been the case. And so short term, yeah, we've had some moves to the upside, but longer term, this continues to be a problem in that commodities continue to drop. The dollar overall has continued to strengthen. Well, the one way, if the Fed really wants to inflate our economy, the one thing they need to do is lower rates, because lowering rates lowers the value of the dollar, weakens the dollar, and that in turn will provide an impetus for commodity prices to rise. And to be honest, I'd like to see the CRB index get back up above the highs that we saw in 2018, actually start to see a little bit of inflation. It wouldn't be a bad thing. So I think the real pressure on the Fed is to lower rates because of disinflation, not because of a slowing economy. Although, I don't know what the coronavirus is going to turn into. Sometimes these just kind of fade and they don't really do much. Sometimes they can become, a big problem and can start to really curtail growth. So I think the Fed's got a couple things to think about this meeting over the next couple of days. I'm not saying they're going to lower, but I wouldn't be shocked. I actually think they should lower, but I don't know. We'll see. So that was the 10-year Treasury yield having a rough day today. I mentioned, and I wrote this in Chart Watchers. Of course, those of you who are EarningsBeats members know that I've been growing much more cautious the last couple of weeks. There were a number of reasons for it. Among those was here you can see the chart. You can see the S&P 500 going straight up for the last 3 months. But one of the reasons, and the reason I wrote about in this article, was the equity-only put-call ratio. And when you look at the equity-only put-call ratio, and you look at the 5-day moving average, which is what this chart's up here at the top, we had gotten to a point, this was as of about 10 days ago, we had gotten to a point where, or to a level that we had only seen 3 or 4 times in the last 15 years. And when you see a a 5-day moving average of the equity only put call ratio get down to this level, what it's telling us is that the masses are getting so bullish that they don't believe the market can go down. And that is usually a recipe for the market going down. The masses generally get it wrong. So when everyone is really fearful, I mean, it gets back to, to the Warren Buffett saying, when others are fearful, I'm greedy. When others are greedy, I'm fearful. That's really the way the stock market works. Now, this doesn't mean that we're heading for a bear market. We had the level in 2014, and it did lead to some sideways consolidation. I don't expect anything like that, but it can lead to short-term pullback, and we see that here. And when you look back over these last couple, you can see the market struggles when everybody gets to a point that they're just feel like we can't go any lower. That's normally when we go lower or when we consolidate, and we've been straight up. So this would be an area where I would certainly expect that we could pull back for a period of time. The volatility index, probably going to hear a lot about this from me over the next couple of days. This is something I'll be watching pretty closely. But volatility index is a measure of fear. It's really a fear index. And it's the expected volatility. It looks at the premiums on options going forward the next month or two and comes up with an expectation of volatility in the market. So as this rises, when volatility, expectations of volatility rise, it almost always coincides with a market drop. So if you take a look and you go back in the market and you see the drop that occurred in April and May, there's your spike in the VIX. Same thing here, July and August. September into the early part of October did the same thing. We had a little scare beginning of September. Beginning of December, right before we had another strong push to the upside. So this is going to be a little bit of a problem in the near term. How high does this go? I don't know, but when the VIX is beginning to rise like this and money is rotating into utilities and real estate, we have to be careful, and that's what we've been pointing out. The other thing that was pointed out, and this was in a webinar. If you join, by the way, you can get a copy of the webinar. But I did an impromptu webinar just because I started seeing so many signs. Rather than try and write it down, which I was doing some of, I wanted to just have a quick webinar with members to say, hey, these are some of the things I'm seeing. Whatever this means to you. If you want to be a little bit more cautious, does that mean go to cash? Does that mean sell puts or buy puts, sell calls? Whatever hedging and cautiousness looks to you, that's what I would be thinking about as we head into the period. But there were a number of things. This was, the VIX. One of the things I talked about was that the VIX was not going back down, even though we were in January breaking out to these new all-time highs. You can see the VIX never went down below the November low, never went down below the lows we've seen in the past year. And yet here we are in this straight heads up, straight up move in stocks, and yet volatility did not go to a new low. That can be a little bit of a warning sign. So that was one thing that I mentioned. October 27th to January 18th, the best time of the year. If you look at the S&P 500 on an annual basis, the average annual return of the S&P 500 over the last 70 years is roughly 9%. Now, when you look at that, you say, okay, well, if every single day was created equal, we would have annualized returns every day of roughly 9%, because that's what the market does, 9% a year. But instead, what I'm saying is that October 27th to January 18th, that rose to almost 21%. That annualized return for that period is almost 21%, which is more than double that 9%. So it tells us how strong the October 27th close to January 18th close is. Well, it's January 27th now. So all of a sudden, we're not in that period anymore. So the historical bullishness is now gone. This time of the year isn't horrible. It's actually not bad, but it's not as good as what we had. The VIX is a problem. The CBOE, getting back to that, chart here with the equity only put call market, everybody's thinking it can't go down. It had the 10-year trend, 10-year treasury yield that was breaking a trend line. See this trend line, these highs? Well, we got into early January and we started to break that. So, and when the yields are dropping, that means more money's rotating into treasuries, which can be bearish. much more bearish in a bear market. I got to point that out. I know that there are a lot of folks looking at the Treasury yield, and they always go back to 2007 and 2000. I think that's a big mistake. I think that we're in a different market than we were. You have to have that different mindset on. But it's still a problem because we want money coming out of treasuries and going into equities. That helps to fuel major secular bull market advances. So when you're going down, it doesn't necessarily mean the market's going to get crushed or we're looking at a crash, but it does mean that money is rotating into treasuries, and that's money that could have been going into equities. So it's always going to be a little bit of a drag. The other thing I wanted to mention is the sectors. I was talking about the sector summary and how these sectors have been performing. If we take a look at this, we've got utilities here. Now, this is just from Friday, utilities and real estate at the top. Let's go to a 1 week chart. What do we got? Utilities and real estate at the top. Let's go to a 1 month chart. Well, we got technology hanging in there, but what do we have second and third? Utilities and real estate. These should not be in there for a 1 month return in a bull market. They should be down here at the bottom somewhere. So while we had technology up there, communication services, industrials, we also had these two defensive groups telling us the market wasn't quite sold on continuing this advance. So there was just a myriad of problems. Now, I also want to talk a little bit about this dollar because this is a weekly 3-year chart, but I'm going to stretch this out. Let's go back 10 years. And you're going to see that overall, see that trend in place, nice uptrend, go through periods of ups and downs. But overall, the long-term trend, if you connect these lows, you'd have a trend line that comes up and intersects probably around 93 or so right now. I'll show you that in a minute. But you've got the dollar that is on the rise. Well, when the dollar is rising, that's when we get the CRB commodities going lower. One of the charts I like to follow is I like to look at what the 10-year Treasury yield is doing in the U.S. versus what the 10-year Treasury yield is doing in Germany. So the 10-year Treasury yield in Germany, well, we saw the U.S. Treasury yields rising faster than Germany's from 2011 into the end of 2018. Well, that's the same time that the dollar index has been rising. If our economy is stronger than Germany's, our interest rates should go up faster. And that's what was happening. Or if we're stronger than them and rates are going down, ours should go down slower. So we're outperforming the yield in Germany. And we did that for about 7 years. And throughout that period, the dollar was on the rise. Well, that's changed in the last 18 months. We're actually seeing Treasury yields underperform here in the U.S. versus Germany. And that should put pressure on the dollar to the downside. So far, it's had limited. It looks like we're starting to roll over, and I fully expect that we're going to roll over in the dollar. But what the Fed should be doing, and I think what the yields are telling us, what the bond markets are telling us, is that the Fed should be lowering rates. Should probably come up with another quarter basis point reduction to weaken the dollar. And by weakening the dollar, you'll inflate commodities. Again, in my opinion, it has nothing to do. Don't say, well, my gosh, the jobs report's this, or, consumer confidence is this. It has nothing to do with that. The Fed has two mandates. One is maximizing employment. The other is stabilizing prices. So in order to stabilize prices, in order to get inflation up to its target level, they should cut rates. We'll see. All right. Anyway, I went through a lot of that. Here's a chart of the S&P 500, and you can see this is 10 years. And down at the bottom is the 5-day moving average of the VIX. Now, you can see back in 2010, 2011, as far as I'm concerned, we did not get out of the secular bear market until we went through 1550 in 2013. That took out those prior highs. So in my mind, the secular bull market started here, not back at the 2009 low. We still were working through things. Look at all the fear. That fear subsided when we got through 2013. Now the normal on major secular bull market pullbacks, we've seen the 5-day moving average of the VIX get up to 25. Now, these are major pullbacks. I don't know that I'm not really looking for a major pullback, not to this magnitude. I think it's going to be something more similar to what we saw in 2019. I'd be surprised if we get more than 3 to 5%. That's a number I'll throw out there. I mean, it might even be less than that. So as the VIX rises, I think a 5-day moving average that gets up to about 15, 16, 17 is probably about as high as we're going to go on a 5-day. Now, one day, I mean, today we might see 20. I mean, I don't know, but I'm talking about a 5-day moving average getting up into the mid to upper teens. I think that could be all we see on this pullback. And we're in a secular bull market. I try not to bet against secular bull markets. We could have a gap down at the open today and then just take off again to the upside. I don't know. But if you're sitting on the sidelines or you've been a little bit more cautious, as we pull back, I would try to rein in some of that cautiousness, meaning I think the market's going to end up turning around and going higher again. So let the insurance, if you bought S&P puts or you sold calls against your positions, you might want to begin slowly closing those out as the market is pulling back. Or if you're in cash as the market's pulling back, maybe what you should think about doing is easing your way in. All right, talked about all that quite a bit, so let me move on. I'm going to go into earnings. Not a lot of earnings out today, but things will pick up. Tomorrow, Apple reports earnings after the bell. Wednesday, we've got Microsoft and Facebook. Thursday, Amazon. Now, those are just some of the bigger names, but obviously we got a lot of earnings reports that'll be coming out later this week and into the next couple weeks. These next 3 weeks, we're going to see a ton of S&P 500 companies reporting. And so I think in the end, that's what the market's going to be focusing on. And what I think a lot of folks don't realize, one last comment about the whole big picture of the market, is that when you've got moderate growth and you've got very, very low interest rates that might even go lower if the Fed pays attention to what's going on with the dollar and commodities, when you look at future earnings growth, and many of these companies are looking at really strong earnings growth, companies like Apple and so forth, when you look at those future earnings and then you discount them back at today's market rate of interest, which is extremely low, those earnings are much, much more valuable. And so that, in my opinion, is the reason the stock market's going to go a lot higher, is that we're in a very, very low period of interest rates, and earnings, I think, will continue to grow. Okay, and I mentioned the FOMC meeting starts tomorrow. They've got a policy decision that'll be out at 2 p.m. on Wednesday. So a lot going on this week, in addition to the coronavirus, which is getting a lot of headlines. All right, so DHI, they came out, they beat on the top line, beat on the bottom line. They guided in line. I figured it would be a decent report. Great area of the market. Home builders have been strong, moving back toward 52-week relative high to the S&P. DHI certainly has been among the leaders in home builders, even though it's come back a little bit. That was during a period of consolidation. It started to turn back higher with this move back up again. I suspect if it does pull back with the overall market, I'd watch 55, 56. I expect DHI will find some support there. Sprint came out, missed on the top line. They did beat on the bottom line, lost 3 cents, and the market was expecting a loss of 5 cents. Stock was up barely in pre-market. I think it was up a penny. By the way, DHI was flat with its earnings report last time I looked anyway. So Sprint fell short on revenue, but the loss did come in a little bit less than expected. This is an interesting chart. Let's try that again. All right. I don't know, every once in a while in the mornings, I think there's something going on. But anyway, Sprint, the longer term chart, maybe if I pull it up on relative chart, well, still not working. Let's go on to the next one, which is ARNC. Now, ARNC, Arconic, this one was a little bit surprising to me because the group was starting to show a little bit of relative strength, and ARNC was at a 52-week high when it's hit this high. Now, it has been moving below the 20-day, but I would still view this as more consolidation off of this breakout. I'd be looking maybe down here around 28, which is where it bounced. I'd like to see this stock hold 28. They missed on their top line, missed on their bottom line. They were really close, 53 cents versus 54, but still it's a miss. They guided their fiscal year 20 revenues lower, and yet we'll see whether or not we can hold that $28 level, down 2.78%. So it's going to hold at the open. The question is, does it hold on the close? If it fails to hold that level, I think this chart starts to look a lot more bearish. Let's see. That's about it among the companies that are out there. One company, GDI, did come out and announce that their fiscal year 19 revenues will be higher than expected. The stock had come off of its relative low about 4 months ago and has been trending higher. The overall group, industrial machinery, has been moving up, but on a relative basis has been moving back down. So a mixed picture here, but the stock did come out and say that they're expecting higher revenues. And I didn't see any kind of a reaction in pre-market to that. I'll just give you a couple of these upgrades and downgrades. A couple upgrades. Biogen was upgraded. I'll pull up CMG, Chipotle. This is one of our model portfolio stocks. Chipotle upgraded today. I don't know that's going to help, to be honest. I think that bearish engulfing candle with volume picking up in the overall market attitude today, I think that's going to be a problem for CMG. So I like the stock. I mean, I'm okay with the upgrade. I just don't know that it's going to hold up. Let's see, downgrades today. We had AXP, American Express after a huge breakout last week. Off the uptrend, though, it did have a black candle. So I think short term, wouldn't be surprised to see it lower. So I wouldn't disagree with this downgrade, but I do think it'll be short term and short lived. Let's see, one other one. Well, there are a couple of others: Intel, Intuitive Surgical, Solar Edge, one of the hottest stocks in the renewable energy area, was downgraded. Probably valuation. This has been a leader in renewable energy, though. I disagree with the downgrade, other than the fact maybe we get a pullback because it's gone up so much. And then there also Wynn Resorts downgraded. And you can see with heavy volume, this was a stock that looked really good a week ago. I don't know what's going on with these gambling stocks, but it seems like every time you get a nice breakout followed by a huge decline, it seems like we get our act together again, another big decline, then finally break out above all these other highs, and here we go again to the downside, gets downgraded. Lots of volume to the downside here, rolling over on a relative basis again. I don't know, mixed picture here, but can't like that volume in the pullback. I'd want to see it hold around 130, and if it doesn't do that, chances are it continues, maybe challenges that 115 area. All right, let's move on to the three you must see to wrap up the show. I wanted to show you a couple of charts because last week there were bearish engulfing candles everywhere. And so I'm going to start with AMD. AMD, bearish engulfing candle. And the thing that bothers me is when you get the bearish engulfing candles and you get the heavy volume and you get the negative divergence, higher prices, lower PPO, that is a trifecta that isn't going to pay much if you're bullish. That is normally not a good combination, and I would expect, I know AMD's been a great performer, but a lot of folks been jumping in. I wouldn't be surprised to see a really quick pullback and maybe even a big one, just to scare a lot of the folks out from the recent top. I still love AMD. I think if it got down to the 50-day moving average, I'd be a buyer. But just in the short term, overbought, bearish engulfing, high volume, negative divergence, that combination is one to at least be concerned about. Same thing or similar thing here with Western Digital. The volume wasn't as big on the breakout. You can see the volume here has been kind of going down. The volume on Thursday on that breakout was down a little bit. It did pick up, but it was still lower than prior. You can see that PPO rolling over, and then on the heels of that maybe cautious candle on Thursday, we get the bearish engulfing candle on Friday with that negative divergence, and once again overbought. I don't know. This is another one that I think I wouldn't be surprised to see it move back into the mid-60s, maybe even the low 60s to challenge that rising 50-day moving average. Last one I have, and this is for all of those of you that like these little companies. NLNK. Now, look at the volume coming in December. The stock ran from $1.60 to $3.60 in 4 trading days. Now, I didn't go back to look at the news. I don't know what's going on here. If we pull it up on a relative chart, you'll see that it is in the pharma space, so it's healthcare. Some of these can be extremely volatile, and this one certainly is. Big move up, but now it's coming back down. It's getting really close to where this thing started from. And when you look at the volume on the selling, it has really been a lot lighter than what we saw on the way up. You have to have, you have to be really an aggressive trader for a stock like NLNK. But this is one that I think looks interesting from an aggressive trader's perspective. And anything back down close to this 165, 170 area, I could keep a fairly tight stop. But these are volatile positions. So, you have to decide if you can put up with that. All right, well, the market has just opened, and here you can see, I just gave you the update here. Dow Jones minus 447, S&P down 52, NASDAQ down 222. Oh, it's not going to be a good day, at least not to start. But anyway, and there is the VIX, by the way, up 4 points to 18.6. So we're going to want to watch the VIX this week. But that's it for now. Everybody have a great day. Happy trading, and we'll see you back here on Wednesday. Don't forget, tonight, 4:30, Q4 earnings. Love to have you there. See you later. Happy trading, everybody.